4.9% real GDP growth just posted, and I'm the idiot calling a Q1, Q2 recession. How can this be? I am not changing my opinion. I'm still going to hold to that camp, but we're going to talk to Taylor and just find out how crazy and lunatic I am being when we just posted 4.9 and I'm calling Q1, Q2 negative.
Yep.
So, Taylor, tell me how off I am because it kind of feels strange right now.
You're not crazy, but it
Oh,
is funny
awesome.
that well, you're crazy, don't get me wrong, but on this
Yes.
particular point, you're not crazy. You're crazy, that's why people like you.
There you go. There you go.
But no, you're 100% correct. So it is funny to start to say, and you're starting to see it reverberate back upward in the news right now. Hey, recession could be more on the horizon than what people expected. And right now, we see a 4.9% GDP growth last week. And so you have GDP just accelerating meaningfully. You essentially have the Fed doubling their GDP estimate for the year. It's
Yeah.
crazy to see how well the economy is doing right now. And I know that it doesn't always feel that way to people, that our economy is doing really well, but the numbers are what they are. 4.9% GDP growth is very swift movement in the right direction. But I think when you look at things and you take a step back and say, okay, let's look at data, let's look at history and say, what is the likelihood that we move into recession soon after seeing a 4.9% GDP? So if you zoom out and look at the last 8 recessions,
Okay.
and you look 3 quarters prior to that recession starting,
Okay.
GDP. So again, 3 quarters prior to the recession starting, GDP averaged 4.6%.
Ooh. Oh, okay. All right.
Yep.
I'm
Yep.
feeling better. I'm feeling
Yep.
better.
And yeah, I'm making you less crazy all of a sudden,
Yeah.
right?
Hey, I'm starting to sound rational.
Well, don't go that far.
I love you. I love
so,
you, man.
so let's look at this progression though, right? So you go 4.6%, 3
Uh-huh.
quarters prior. Then you
Okay.
fast forward to the next quarter, 2 quarters prior to the recession. It
Okay.
drops off 3.5%, still
Mm.
really meaningful
Yes.
economic growth
Still okay. Yeah.
above historic average trend.
Yep.
And then you look 1 quarter prior and it falls off.
Ooh,
0.8% GDP growth.
there
So
we
you go
go.
4.6 down to 3.5, and then you go all the way down to 0.8%. And
Okay.
so that's the reality of like, listen, everything seems to be humming right now
Mhm.
from an economic standpoint. And again, it might not feel that way, but that's the
Yeah.
reality is things are going really well, but things can turn relatively meaningfully in a short period of time.
Yeah. And I just think we are operating obviously in a unique time. You and I are both students of history. It is paid to be that. But we have to remember the unique environment we're in, right? The $9 trillion that were printed. We have QT going on. We have negative M2 money growth. I mean, folks,
Yep.
M2 money growth is negative for the second quarter in a row. Might even be
Yep.
the third quarter in a row. That hasn't happened since the Great Depression.
Yep.
Um, we have
That
student loans
essentially,
kicking back in. Go ahead.
let me just draw some context around that. M2 money growth is essentially how much money is in circulation. So it's not how much
Mhm.
money do people have stored in their bank or whatever. It's
Yeah.
how quickly is money spent, the speed of which money is spent. And right now it's really, really slow to your point.
Yeah, it's really, really slow. And again, we got student loans. We'll talk about car delinquencies. There's just, to me, it just feels like we were running really fast and now we're in mud.
Yep.
So I think momentum's going to slow faster even than, I mean, that's what I'm calling,
Yeah.
that's why I'm calling a Q2 recession.
Is it fair to say that you perceive where we are right now is kind of in the eye of the storm, where you get this relative calm for a period of time
I
and then the
actually
winds
would
start
call
to pick back up?
Q3 was the eye of the storm.
Okay.
Q4 is going to be a lot more like we're entering the other side. I
Yep.
think the Q4 numbers are going to be shocking how fast they deteriorate, but there'll still be positive GDP growth, kind of to your story, right? We'll go from 4.9, I don't know, to 2.1 or something. But I
Yep.
think Q1 is slightly negative. Q2 is substantially more negative. That's kind of what I'm calling for right now.
Yeah, and the thing is, and we can create shock and awe by talking about the meaningful pickup in delinquencies that you've seen in credit cards and in car loans. The reality is, it's actually running at historic norms right now. Delinquency rates are about at historic norms. So they're not at a scary point, but you have to realize where they're coming from. On the last
Right.
episode, we talked about rate of change, that being the important thing to stare at when it comes to anything from an economic standpoint. And the rate of change is picking up meaningfully. So right now we're at historic norms, but we just came from everyone and their brother getting a stimulus check, every company getting a PPP loan, and it forced delinquency down to absolute historic low rates. And so now you have them coming back up into the point of where they're right in line with historic norms, but they're coming from a really muted spot. And you look at this and say, normally you do not see a meaningful pickup in delinquencies when unemployment is really, really low. Guess what? That's what we're seeing right now. Extremely low unemployment and a pickup simultaneously in delinquencies, which normally doesn't happen.
Yeah. And there's just a lot going on in the economy. We're starting to see more and more folks where tight lending is actually crimping what will be GDP growth. We're hearing more and more kind of small builders, frankly, refusing to build,
Yep.
right? Which is going to be a negative drag on GDP. We're seeing more and more companies not be able to borrow money, so they're
Yep.
having to curtail capital
Yep.
investments. Kind of best case, worst case, they're whacking heads to get their positive burn rate.
Yep.
The All In podcast, those four guys are talking about companies finally getting real about burn rate, and they're having to take significant write downs in their past valuations. I just think we're to the point in the cycle where people are realizing there's real pain ahead. And I think we're going to see people in Q4 make some tough choice. People meaning companies and businesses and just all of that, I think.
Yeah, and the All In podcast that you referenced there, those guys are awesome. And they're talking about, again, the fact that people are starting to actually take a look at burn rates. Guess what? That's because they can't get financing, right? So
Exactly.
when financing tightens up and VC companies, venture capital is essentially dried up right now. They're not
Yep.
going out and looking to take on a ton of risk and redeploy money into new tech startups, et cetera. And so that's obviously seeing that play out. And then on the other side of it, you also have more tangible stuff looking at the SLOOS report. So the SLOOS report is what banks essentially report their lending standards. And starting at the beginning of this year, lending standards have meaningfully been coming in, right? They've been tightening the belt. And then you obviously have the blow up of SVB rather, Silicon Valley Bank, First Republic Bank, et cetera. That just exacerbated that turn. And so if companies can't get financing, it becomes a really tough environment. And guess what? Look at the KRE index. That is regional banks. They're on the map right now. So they fell off, obviously, when you had that Silicon Valley Bank blow up and they drew down 40%. And then they muddled along a little bit there and they got a little pop. Guess what's happened recently? They've sold off again. Why? Because they're looking at this. Investors are looking at this and saying, they're telling us they're not lending. That's their profit center. We're looking at a GDP print of 4.9%. What is the Fed going to do during that time frame? Does that make them more or less likely to cut rates? Less likely to cut rates.
Yeah.
And so, you see it from all directions right now. Lending is very tough to come by. And by the way, I'm in the cohort of a 35-year-old age bracket. I have a lot of friends that cannot afford to buy a house because interest rates are at 8%. If they were at 2%, they'd be buying houses, or 3% that they were 3 years ago. They'd be buying a house right now and starting that family. Now they're starting a family in a rental. And you know better than anybody else the knock-on effect of what goes on in the real estate market between the lending agencies, mortgage brokers, et cetera. And then it spirals all the way down to the builders, to furnishings, to everything that goes on regarding the housing market. It accounts for about 15% of our overall GDP from a country standpoint when you build in all of those stakeholders.
Yeah, it was really funny you bring this up because, again, I've been calling this for quite a while. Goldman Sachs just came out and said we're going to do 3.8 million existing home sale transactions in 2024. And I'm like, yep, you're right. That's where we're going.
That's the number that you've been saying is coming to fruition for about a year now. And your spreadsheet that you sent last week that people can access on your website for free just shows amazing amount of data. If people want to look at an Excel spreadsheet and say, okay, where are things at from a historic basis? They can look back and say, okay, when interest rates were here back in whatever year, this is what's happened.
Yeah, that spreadsheet is what gave me the confidence to, because it would have been really easy to call a home price crash. When rates went up 400 or 500 basis points,
like everyone else did.
Yeah, like everybody else. And frankly, just be like everybody else, and you can grow fast on YouTube. But the numbers just said, I don't think so. And thankfully, we got receipts, and we were right. And it was all because of that spreadsheet. Go to onerentalatatime.com. There are 8 boxes, the lower right corner. Give me your email, and the system will just automatically email you the spreadsheet. Also on the spreadsheet, the last worksheet is the list of data sources. So these numbers aren't made up right from the St. Louis Fed. You want to audit them, go audit them. Go crazy. Taylor, where can people find you?
Yeah, find us on Instagram and TikTok every day at LifeGoal Investments, putting out just short clips on what's going on in the market and the economy.